This week on Generating Alpha, I sat down with Dmitry Balyasny, founder, managing partner, and chief investment officer of Balyasny Asset Management, one of the most respected multi-strategy hedge funds in the world. Dmitry immigrated to the United States from Kiev, Ukraine, at age 7, speaking no English. He worked as a door-to-door salesman at 12, became a stockbroker in college, and started his trading career at Schonfeld Securities in 1994. In 2001, he co-founded Balyasny Asset Management, which has grown to over $30 billion in assets under management with 2,300 employees across 23 global offices. Beyond building one of the industry's leading multi-manager platforms, Dmitry is the only founder among the big four multi-strat funds who still actively manages a book. He's also deeply committed to expanding opportunity, founding Atlas Fellows in 2021 to provide under-resourced young people with pathways into finance and investing. In our conversation, we talked about immigrating to America and learning to trade, the formative impact of Atlas Shrugged, losing everything his first year as a broker and why he persisted, what he learned at Schonfeld about building great hedge funds, the critical decisions that shaped BAM's evolution, what separates great analysts from great PMs, how culture translates into returns, the changing nature of edge, and much more. If you enjoy this episode, please follow the podcast and rate it 5 stars on Spotify, subscribe on YouTube, and share it to anyone who you think might find it valuable. I really enjoyed recording this with Dmitry, and I hope you guys enjoyed listening. Thank you. Thanks, Dmitry, for joining me. It's been a long time in the making. I really appreciate it.
Thanks, Mir. Nice to be here.
Well, I want to start where I always do, the beginning. You immigrated from the United States to Kiev when you were 7, I believe,
Other
or
way around.
oh, Kiev to the United States when you were
You don't
7.
want to immigrate the other way.
Speaking no English, tell me a little bit about your childhood, how you think that experience shaped you, what it was like growing up.
Sure. It was tough for me, but it was really tough for my parents, and they're the ones that certainly get all the credit for having the courage to make the move. Um, just to give some perspective for folks who might not know kind of what's involved, or at least what was involved at the time. When you submitted your papers to leave the country and immigrate in the former Soviet Union, you were immediately like ostracized and were kind of persona non grata in the country. So my parents, immediately lost their jobs and had to live off of, kind of meager savings and kind of gradually selling off your personal possessions as you try to sort out, everything you need to kind of make the move. And today, we have such a preponderance of information about everything with, the internet and AI. At the time, it was just like a void, right? So you had really no idea besides kind of hearsay of what was, outside of the, Soviet borders. And so, they really took, a leap of faith and fortunately worked out. So we immigrated to Chicago and I grew up there. My parents had, never driven a car, had to figure out how to get a driver's license, had to figure out how to learn English and start over in very menial jobs, like going from, working as a professor and working as an engineer to working cleaning motel rooms until they kind of got their feet under them, and we slowly kind of made our way out of the city into the suburbs and et cetera. And for me personally, it was strange. On the one hand, it was amazingly exciting because you saw like all these things that you had never seen before, whether it was flying on an airplane, which my kids can't believe that I'd never flown on an airplane before that, um, or really driving in cars, which didn't really happen very often. To going to a grocery store and actually having it like filled with stuff that you could just buy. These are all kind of very novel experiences. But from a kind of personal standpoint, on the other side, starting over like with no English, I came when I was about 7, going to be 8 soon. I was put into third grade. I couldn't speak any English, and after 6 months in third grade, they moved me down to second grade. Then the following year, kind of got the hang of English a little bit and got caught up. And then I went to fourth grade. So I still never really finished third grade. So if I say anything really dumb during the podcast, that's the reason.
I think you missed a little bit of division there. Um, and so I also think kind of a moment. that seems very formative for you is when you read Atlas Shrugged for the first time in college, if I'm correct, and Ayn Rand in general seems to have been very formative. Tell me about, first of all, time in college, and then reading that book. What did that bring to light?
Yeah, it was, I think it was right between my senior year of high school and freshman year of college. Um, so it also like lined up with kind of from a formative kind of standpoint. When you're going to college, you're kind of like looking for new ideas. You're open to kind of like different perspectives and stuff. And I think, at least for me, like I was kind of hungry for um, knowledge, right? Not like factual knowledge, but kind of like broader, wisdom and knowledge. And so I was always kind of interested in philosophy and reading different, philosophical type books. Uh, Atlas Shrugged sat on my bookshelf for a couple of years prior to that, and I was kind of intimidated by the length and didn't really know what it was about. And so it took me a while to kind of motivate myself to start. But once I started reading it, like I couldn't put it down. And I think the best way I could put it is it like Ayn Rand put into very eloquent writing a lot of moral and philosophical kind of thoughts that I had kind of bouncing around in my head, right? Where I couldn't articulate them the same way. I couldn't put them together into a coherent, philosophy. Um, but it immediately resonated with me as far as freedom, independence, self-determination, working kind of for your rewards, and all of that being not just a sort of cost of doing business to keep the world moving, but actually the right moral way to do things that was beneficial for society as a whole, as well as the individual working in their own self-interest. And so it really resonated with me, and I would definitely recommend it for folks to check out.
I've been intimidated by it for a few years now. I think I'll pick it up after this podcast. Uh, and during your time in college, if I'm correct, you became a broker because ultimately you wanted to become a trader, but the broker was kind of the first step to doing that. You made some money from commissions being a broker, and if I'm correct, you kind of didn't make any money in the end because you traded them and lost a lot of the money. Um,
Yeah, I was definitely net down. So the career trajectory was I did some sales when I was in starting in junior high and then throughout high school, different types of sales jobs. Um, because I pretty quickly figured out that was the only way you could get paid any money as a kid was you had to earn commissions. Podcasting hadn't been invented yet. I wasn't smart enough to start a VC fund, so uh, I did different types of sales. Um, and so as I was looking to get into finance and trading, it was kind of natural that I could get like a foot in the door through sales, which is basically what being a stockbroker was at the time. You got a stack of leads to call and people you're trying to get to open accounts and do some trades and investments, with the firm. And I was pretty good at that, and I pretty quickly had a number of other young people kind of working underneath, my umbrella. And we were doing, very well for our age, like as far as generating revenues. But I was really interested in trading, and so I was taking like all the commission earnings that I was making and using that to fund my personal trading account. And there I had like no idea what I was doing, and so I was losing that and more because I was, young and silly and leveraged that with by levering via credit cards. So that was my early version of prime brokerage, which was not the way to do it. And I didn't know what I was doing, and so I was losing more than I was making, and got to a spot to where I really figured out that like I needed to get some formal, mentorship to really figure out how to trade properly.
And then you saw the only ad that Schonfeld has ever run in a newspaper, if I'm correct.
Yeah.
And I'm also just interested. So first of all, tell me about kind of your start at Schonfeld and your trajectory there before spinning out to BAM. I'd love to hear that. But even before that, most people who lost a lot of money trading early on might have been like, okay, this is not for me. Why did you keep on going?
Well, one, I really loved it. So I was doing it not just to make money. I was doing it because I was really passionate about trading and investing in markets and companies, and I was always very interested in it. So that was one. Two, like I'd never really been naturally good at anything. So I've had to pretty much work at, anything that I become competent at. I usually have to spend a lot of effort to get there.
I can relate.
Um, yeah, right. And so I kind of figured because I had that, kind of backbone from working my way up in other things, whether it was sales or sports or whatever, I figured if I really loved it, it's not, kind of rocket science. If I worked at it hard enough and got some reasonable instruction, like I could eventually, figure it out kind of step by step. So that's kind of where that I think confidence came from.
And tell me about that. How'd you get started at Schonfeld? And very interesting career trajectory there, all the way from started just by
Yeah,
yourself, then you ended up running a team, and even on the fund to fund side, how did
yeah,
that kind of were the steps leading up to spinning out of that and starting BAM?
yeah. So I guess first off, like just the perseverance in getting the job, I think is important. So um, at the time there weren't lots of different hedge funds to talk to. Certainly not in Chicago, and I didn't really have any experience that was useful for them to be interested. Um, so I kind of cold called and sent resumes and networked with as many as I could find, and I had a very large stack of rejection letters. But I would go through the paper every week, kind of looking for want ads for trading positions. Back in the day, that's amazingly what people did. And so if I hadn't been doing that, I wouldn't have actually seen the one ad that Schoenfeld ran at the time. So that was helpful. And then they were looking for people that didn't have a lot of trading experience, but had like a little bit of market knowledge. But they wanted to teach them kind of the approach that they thought worked and not have people come in with preconceived notions. And so I was very clear that I had no idea what worked, and I wanted to learn. I was going to work hard, and so I was hired into the training program. And we had no compensation, no salary. Today there's lots of signing bonuses and multi-year guarantees, and all this and that. We got free lunch, and that was it. And then you got a percentage of the profits that you generated from your trading account, but you had a very small pool of capital to start because the firm was trading its own capital. And as you didn't know what you were doing, like it made sense to start people with a small amount of capital. And so the first year I didn't make anything there. And there were some people there that didn't make anything for years and eventually dropped out. But I kind of persevered and kept asking questions and kept kind of slowly improving and learning different disciplines and types of trading and types of risk management that worked initially in equities and then broadening it out to macro, et cetera. And so after the first year, I kind of steadily started improving and consistently putting up solid P&L. And as that grew, I started hiring people to work underneath kind of my P&L center. Initially hiring traders who I basically taught, what I knew and gave them some responsibility to take a portion of my risk in different sectors. And then started hiring analysts 5, 6 years into it. Uh, we were kind of the first group in the firm to hire like fundamental analysts, which was an unusual thing to do in the 90s because it was such a momentumy market. But I thought that wasn't going to last forever, and if I wanted to keep scaling and growing, we needed to do kind of fundamental work and hold positions longer. And so we started doing that. And then that morphed into hiring sector portfolio managers, where we gave them more capital to manage kind of underneath my umbrella. And then that became kind of the genesis of our trading group. And as we grew and expanded, we wound up spinning it off initially into a division and then into a separate fund entity that we capitalized.
And I'm interested in what you learned at Schoenfeld, both from building a team over the years, but also, if I'm correct, you're on the fund of fund side for a bit and got to interact with some of the top funds at the time. What did you learn there about what makes a great hedge fund, and how did you apply those kinds of principles to the beginnings of BAM?
Yeah, that's a good question. So, on the trading side, I would say having a disciplined, specific approach. So the markets have lots of things going on all the time, right? There's a million different types of trading and investing that you could do in different asset classes, different holding periods, long, short, neutral, investing, trading. So there's a million different things you could do. And generally, people don't really have a particular well thought out, approach, right? They kind of do something, it works, they do a little more of it. That doesn't work, they do something else. They try this, they try that. And so that's kind of what I was doing before. And you really need a particular approach. Like, this is the type of trade that I look for, right? And this is the type of risk that I take. Here's my limits. Here's what I'm trying to make. Here's what I'm limiting myself to lose. And have like prescribed method to the madness, right? And you start with a fairly small, box, right? So when we start, new portfolio managers who hadn't run money before, we try to make the box, fairly tight. And when I started, it was really tight, right? Because we really didn't have much experience. Today, the people we have starting off in a PM training program already have a lot of experience, so they have a much wider box. But you need that box. So that says, like, here's the stuff that I think I have an edge in, this particular portion of the market. Here's how long I typically hold positions. Here's the factor risk I want to take or not take. Here's the concentration, the liquidity, how much I'm trying to make, how much I'm willing to lose as a drawdown. So you try to like define all this stuff. And then as you get competent, the more success you have, you kind of gradually widen out, that box, right? And sometimes you have to take, you grow it, and then you have a drawdown, something changes in the market, and you have to shrink it again and go back to your basics a little bit. But over time, that's kind of how you develop, right? And then you're constantly looking for, improvements in your approach, not just what happened with this particular trade, but how can I use what I learned so that my next, 1,000 trades are better, right? So you're constantly like iterating a little bit, right? And then from the fund of fund side, I was allocating a kind of a firm account that Steve Schonfeld capitalized and I co-invested and a couple other guys. And I was kind of the fund of fund analyst. I went around and met like a bunch of different funds to help pick where we should be invested. And so that was a really interesting experience. I'd say the main thing that was really reinforced to me that was helpful was there's like a huge difference between two types of funds. One is kind of a boutique structure that's structured around an individual risk taker in a particular strategy,
The Steinhardts
right?
of the
And
world.
yeah, and that's like the vast majority of hedge funds, right? And then there's like a business, right? And it could be a proprietary trading business, like a Jane Street or HRT, or it could be a hedge fund with a lot of different risk takers. And that's a completely different DNA from the individual centered model. And what I saw, like as we were allocating, the portfolio was split between kind of the two models. We had a lot of different funds. The single manager model had like a tremendous amount of turnover.
Mm.
So some did great, then they didn't do great, then the manager would want to do something else or lose motivation or had some business issues. But it was very rare that we were invested with the same guys for 10, 20 years in that part of the book. They were just like turned over a lot, right? Um, versus the diversified funds, like a lot of them wound up being the same ones for decades, right? Or they would like spin off and you have like, they become one would become two, but it was the same basic kind of DNA, right? And the reason for that is like that type of firm, like you can reinvent, right? You can expand different strategies, some work, some don't. You change the mix of strategies. You can allocate capital to the areas of the market where you think there's better opportunities. You can refresh your investing teams as people kind of develop and get better or not over time. So it's just a much more stable and consistent business model. So that kind of reinforced that was the way that I wanted to go in really building out, our business.
Yeah, you wanted to build a business and a legacy rather than something more fleeting.
Yeah, I just wanted to build a real business, right?
Yeah.
So whether I had a good year trading or not, like I wanted the firm to do well, I wanted our investors to do well, and I wanted to do well in all market environments. So
Mhm.
some are great for my style of trading, some are not. Like I wanted it to be, a consistent, scalable, business.
And I'd love to hear a little bit about, before we touch on talent and kind of different topics, I'd
Mhm.
love to hear a bit about from a high level perspective, how BAM has evolved over the past 25 years. But I'd love to hear it from what you think were the most important decisions that led to it becoming what it is today. Um, yeah.
Well, I think the first one is just that what I was talking about is just what is the architecture? What are you trying to build? So a lot of times when people start funds, they start from the standpoint of how much money can I raise, right? What will people invest in? And you obviously have to think about that, but that shouldn't be, kind of the genesis of what you're trying to build, right? Because like investor appetites, they change, and they certainly will follow returns, right? And you need something that you really believe in over good periods, bad periods, that you have a particular edge in and you know how to do, and architect the firm, towards that, regardless if it's easier or harder to raise money for it, to start, right? So, and the reason I say that is like this model was really hard to raise money for. And we had like a lot of ups and downs over the years in AUM before we kind of got to real critical mass and a really solid, investor base. Like that took a long time. And the reason for it is that it's like a complicated model for an investor to underwrite. So if you compare it to, an individual single manager PM coming in and saying like, here's my track record, you're investing with me, I'm great at XYZ. I have this team, we got 5 guys, we worked together for 10 years, simple fee structure, simple risk, like here it is, right? Versus we come in and we're like, well, the PMs change. Like we have 100 different people. Today we have 200 different PMs. There's, a couple thousand people. So all these different strategies, like they're going to evolve over time, right? Like everything's complicated. And so it takes investors like a long time to get comfortable with that. But, really having conviction that that's the model that I wanted to pursue was super important because that conviction gets tested, right? And a lot of people, want to do a particular model, and then when times get tough, they're like, yeah, I don't, maybe I'll do something else, right? And so, we really architected that we wanted to build like a really diverse, scalable business, a real, multi-risk taker, multi-strategy. And we stuck with it, and we created a fund structure, risk structure, recruiting structure, everything built, around that foundation. So I'd say that's kind of the first, critical thing because it's very hard to veer from, kind of a single manager to then say like, okay, I'm going to have like lots of different risk takers, and now we're going to do multi-manager. Like that's very, very hard, right? So I think that's been critical to success is just that steadfastness. Then a partnership culture is really important. So I was fortunate enough to hire Scott and Taylor as two partners very early on, and we started the business together. So we've been together for like 25 years, and that partnership culture like permeates the firm. Now we have 20 partners, both strategy heads on the business side, department heads, and portfolio managers as well. And so that really feeds the team type of environment where people want the firm to do well and are rooting for the overall firm. Uh, in addition to obviously being very motivated and the economics that they get from generating P&L on their own, portion of capital that they're managing. So I think like combining those two things, like it's very hard to do, and most firms are kind of one or the other. And we've always believed you could be both. Like you could have individual incentives and you could have firm incentives and firm partnership, and those things really reinforce each other. So I
And I'd
think
love to
those
touch on
those,
the,
those are the main ones.
before we go back to the episode, I want to take a short break to talk about my sponsor, Row. The Generating Alpha podcast is presented by Row, the all-in-one banking platform for startups. Thousands of startups like Perplexity, Product Hunt, and more use Row. You get everything you need to manage your startup's cash. Fast banking setup, cards with up to 2% cash back, and yield that turns company cash into extra runway. All super important in the early days of launching. But the thing founders really love about Row is their team. They're obsessed with helping founders disrupt the status quo and will go to the end of the earth to help them to do so. And exclusively for Generating Alpha podcast listeners and viewers, you'll get a $1,500 statement credit plus a ton of exclusive perks when you manage your company cash with Row. Terms and conditions apply. To learn more, visit rho.co/generating alpha. Row is a fintech, not a bank. Checking and card services provided by Webster Bank, member FDIC. See reward terms for details. Thank you, and back to the episode. Yeah, and I'd love to touch on the topic of people. I think obviously what makes these firms enduring is kind of a consistent flow of great talent. And so I'm interested, just to start off, what makes a great analyst and what makes a great PM, and how do those differ?
Yeah, good question. So, what makes a great analyst, and I think this is similar to a great PM, is you have to be able to think differently, right? You have to come up with unique, variant ideas, so differing views on things that lots of other people are constantly looking at, right? And you might not have a differing view necessarily for the next 5 years, but you should be able to come up with a consistent flow of differing views for the next few months, maybe the next year, maybe the next couple of years in some cases, right? So that takes a particular type of wiring where you're kind of constantly looking at like the other side of the coin and what might cause people to come around to your view and then digging on that. So the balance of creativity and investment process discipline, right, is like common for both analysts, and you need that for PMs as well, right? So a lot of times people that are like really creative and come up with brilliant ideas, like don't have like process discipline, and they might fall in love, with one particular idea, right? They have a hard time kind of, running models on 100 different companies, right? Like you need kind of both things. Right? So that is in common. I think the thing that's different is at a PM level, you certainly need more risk tolerance, right? Where you're comfortable with volatility, and some of that is innate, and some of it can be learned, right? You need the ability to juggle lots of different balls, right? So as an analyst, the great thing about being an analyst is you can go super deep on a particular thing and not worry about anything else for some period of time, right? So if it's a big enough idea, you can raise your hand, talk to your PM and say, listen, like, I think we should spend whatever the next, week, I'm just going to work on this, right? And if you agree that this is like a big potential thing, like I'm going to spend 90% of my time digging on this until we either prove or disprove this thesis because I think this could be a really big bet, right? As a PM, like you don't have that luxury, right? Like every day there's something blowing up in your book. Hopefully there's something well going on. There's some macro problem. Somebody tweeted something. There's constantly, 50 different things that you're juggling. And so the ability to do deep work and dig in on something, but also to zoom out and look at the overall portfolio and constantly, balance those things. That's like a unique, PM skill.
And on the topic of talent, in recent years, a lot of people have seen these big headlines of hedge funds paying up for big talent. But I do think that at a point, kind of the marginal compensation doesn't really matter rather than the type of firm you'll be going to. An extra $1 million on a $100 million contract isn't going to matter as much as the firm. And so my question to you regarding that is, how do you guys kind of uniquely position yourself to attract the best talent as a firm?
Yeah, so I think once you're at the level economically to where you can compete, right? And I think realistically, 99% of funds don't really compete in this pool for, actual portfolio managers that are running meaningful books and getting paid on their performance because they don't have the economic, ability and scale and structure to compete for that. So once you're past that and you're competing with other large firms in that space, if the main thing that you're offering is a sign on or a guarantee check, like that's not like really compelling because it is fairly commoditized. Like if you're a strong PM, you have a good track record, you're a good team manager, you're a good risk manager. Uh, like maybe somebody needs that particular coverage area more than somebody else. But in general, like you're going to get paid very well if you go to any of the top firms, right? And so you really have to differentiate, in my opinion, beyond that, right? And you see this all the time in sports, and I do think it's somewhat similar. Like the athletes certainly want, security and to get paid for their talent, rightly so. But you also frequently see them taking like a smaller check or certainly smaller guarantee to go on a winning team, right? Or to go play with guys where they want to be on that team or for play for a particular coach. Um, and have the ability to bet on themselves and bet on that team. And then if it works out, they'll wind up doing, hopefully even better financially, right? You see that all the time. So I don't think it's that different. So we try to, beyond the basic, economics, like being one of the larger places that can offer that. Beyond that, like, can you offer like the central resources that they might not have somewhere? So, strategy research, policy research, economics research, collaboration across equities, credit, macro, commodities, quant, arb, all these areas where guys are constantly talking to each other and comparing notes on what's going on in the macro, what's going on in the market, what's working. Having great QR functions that work with the teams to optimize their risk taking, to give them suggestions statistically on like what works, what doesn't work for them, for others. And then just having like a very supportive coaching mentality and a partnership mentality where we're going into this venture, together, right? We're both making a bet, right? Just kind of like venture capital, we're both making a bet, and we're going to do everything possible to make the team successful, right? And not to say that if somebody loses money for years, like we're not going to give up and make a change. We have to be disciplined on it. We will, but before that, we're going to do everything possible to make the team successful in terms of resources, coaching, team development, anything that we can do to help them get to where they want to go, as opposed to like, here's your capital, here's your risk, good luck. If it works out, great. If not, we'll get somebody else.
And on the topic of playing for a good coach, there's this idea of like coaching and developing talent. And over the past year, I've gotten to know you guys in your campus recruiting program quite well. But
Mhm.
there's obviously the campus recruiting program and then all the way up to like the PM coaching program. Um,
Yep.
and so from a high level, how do you guys internally develop talent from analysts to PMs? And what cannot be coached is also a question I have.
Um, I think risk is tough to coach. I think people have an innate kind of risk personality, and I think you can influence it, but it's hard to move it a lot. So you just have to go into it with eyes wide open that somebody that's super conservative, you're never going to get them to really be aggressive. And somebody that's super aggressive, you're never going to get them to be conservative. So like wherever they are, you can help modulate them a little bit. And hopefully you can help the offensive person play like a little better defense and the defensive person play a little bit more aggressively when opportunities are there. You're not going to hugely move them. So that's, kind of innate psychology thing that you have to be, comfortable with in the screening process. We look for passion a lot. Like, is the person like super excited to be in this business, in this firm, in this role? Because like these are hard. Like there's huge ups and downs. There's miserable periods when nothing is working. You feel like the biggest idiot in the world. You can't put two cents together. Everyone goes through those periods. And if you don't really love what you're doing, not excited, you're gonna kind of like either actually give up or psychologically kind of go through the motions, but not really, do everything that you can. So those are a couple things that we do. Um, the different programs, we have everything starting from a college recruiting program where we have uh, kids come in from all kinds of top schools and investment clubs and math programs, and they'll go through a summer internship that's structured, and we'll typically hire or make offers to about 65% of those kids. And we wind up hiring over 50% of the interns every year. I think this last year we had over 100 interns. I think this next year is probably going to be 130, 140 globally. So that's fun, exciting, and they take jobs like throughout the firm, some in the technology, some in risk, some in investing, some in trading. Then you have analyst training programs. And as an analyst, the majority of your training should come from your portfolio manager. Like it's a bit of a Jedi relationship that you're signing up for. All right, so you gotta like your and respect your Jedi and think that that's somebody you can learn a lot from, and vice versa. Um, and that's the primary one. But in addition to that, we try to do a lot of stuff centrally because we have a lot of Jedi's, and so you can pick up different things from different people, different strengths, different techniques, different strategies, and so we'll do central things, whether it's an offsite where different PMs will be on panels talking to the analysts, dinners, kind of in office gatherings, all sorts of stuff where some formal, informal, where somebody will talk about their experience, examples, and you go through kind of this formal knowledge, transfer, not just from the direct person you're working for, but throughout the firm. And then we try to put all these in a recorded format so people can get the benefit of all the sessions that have been done, prior. And so you have like this amazing kind of encyclopedia that you could go through and hopefully learn from other people's mistakes and avoid, having to make all of them yourself. And then you have the PM training program where somebody who's typically a great analyst or a great trader already and now wants to move up to the PM seat. And there we'll allocate capital to them, help them build out the team, and work to teach them the portions of being a PM that they might not know. Right. So they might be great at picking stocks, but maybe they haven't managed a team before. Maybe they haven't managed risk before. So there's a lot of both formal and informal training, around those.
And I picked up on something you said, which is when you were describing the departments, you said there's investing and there's trading, and a lot of people kind of see the overlap of investing and trading are the same thing. What is the difference between investing and trading to you?
Well, it's a little bit technical, and it depends a bit on by strategy. So in macro, for example, when you say somebody is a good trader, it's typically the same thing as a good portfolio manager, like they're running. Portfolio tends to be a very trading oriented strategy. When you look at equities, there's kind of like different titles. So somebody today who's a trader in equities, like they're typically on the trading desk, like working orders, helping optimize execution, um, helping the portfolio manager trade the portfolio. And the portfolio manager is typically like a little bit more fundamental. Usually started off as an analyst, although we have some that started off as traders, and they're digging through the research with the analyst, trying to pick the best kind of investment ideas. So it depends like a little bit on the strategy.
And you can't talk about people without talking about culture. And so, how does culture translate all the way from culture in the building to returns for your investors?
I think it's all important. So many examples. Like one is when you go through a really difficult period, if you don't have a strong culture internally, like often businesses fold, or if they don't fold, they get like pretty permanently impaired. And you see that a lot, whether it's, public companies and you trade their stock and you look how companies recover from difficult periods or don't. And the list of top companies, is hugely different, every decade. And hedge funds, if you look at the top funds, 10 years ago, 20 years ago, there's not a lot of overlap. There's some, typically like the multi-strategy firms, a few others, but there's huge change. And a big reason for that is there's not enough that people are buying into beyond kind of their current job in most funds, right? Um, if you're tied a little bit to the more to the business and you really want the firm to do well, in addition to obviously you want to progress in your own job and do great. Um, when you want the person next to you to do well and the firm to do well, like the whole thing is just much more solid, just like a lot more cohesive, and it's a lot stronger and able to get through, all the ups and downs, right? Um, so whether you look at a period like, 2008, where, we wound up making a little bit of money, but we had 50% redemptions because people needed cash from other places and we paid it out. And we had a big head count and had to, cough up the difference, from the management company. So, oftentimes when people want to start funds, they're always talking about like how much they're going to make on management fees. You know, 90% of the time we lose money on management fees, and a couple of those years we had to put up a lot of money on the management fee side to get the business through it. But because of the culture, like we didn't lose many people. You know, same thing. You know, we had one down year in 2018 out of 25 years. Again, lost a lot of AUM. I had to do a lot of restructuring. We lost a few people, but not many. And I think most firms, like if you don't have a strong culture, it's very hard to get through that. And then the other side of the coin is the offensive side. So when things are going well, right, I think culture also really helps you amplify the returns because if you don't really care how the person next to you does or how the overall firm does, you're not really going to collaborate with them to make them better, whether it's an investing insight that you could share that doesn't cost you anything but it'll help them, or it's a process insight of, your analyst is like a bit unhappy. I heard him talking by the water cooler. Maybe you should take him out to dinner and see if you guys get on the same page. It could be a process insight on, here's this new trick I learned in AI that is super useful for my investment process. Maybe you should try this. There's like a million things like that every day, but you need a culture for that to permeate the firm. And when it does, and you can permeate that across teams, across asset classes, across strategies, like everyone just becomes much better faster. Like you just get the flywheel going. So I think it's super important both like defensively and offensively.
And I'm interested in this aspect of communication because there's some multi-managers that infamously are
Hmm.
known to be very like not
Hmm.
communicative. And so you guys seem to have a very communicative culture.
Hmm.
Why did you pick to have that? Or why do you choose to have that? And what do you think your upsides of that?
So there's no perfect system. There's the right thing for different firms and what you're trying to accomplish, but it has to fit with the architecture of the firm. So to me, if you have a generalist mandate type of place where people can trade like a lot of different things, and there's like a lot of overlap between what different people are doing. In that case, you really have to be very careful about the communication in between because you could wind up with a lot of unintended correlation. Right? So that's kind of one model. We've always driven towards a specialized model. So we don't have very many pockets where there's like a lot of overlap. So you'll have people that have, a particular equity sector or geography that they trade, or particular macro mandate that they trade, particular commodity product that they trade. And we don't hire, many people to trade the same types of things. All right. We do a lot of analysis of like, what is the alpha pool in this particular strategy? How many teams do we need to kind of cover that? What's like the rough, optimum number, and then we adjust that over time. And so you want to get to a spot to where there's like enough coverage to pick up a lot of the alpha at scale, but not so much that you're creating like a lot of friction and preventing people from collaborating, right?
Of course.
And so if you have that and you don't have any particular team managing too much of the overall risk and having too much overlap with anybody else, then I think the risks of them talking to each other, I think, are much lower than the benefits you get from that. Right? So there's kind of like a preconception that, if three PMs will talk about an idea that they're all going to like agree and have groupthink and go do the same thing. Most of the time, what actually happens is they'll wind up, arguing for an hour and have three completely different views and have, if they could have three different positions, they'll have three different positions, right? And if they all actually do agree on something and come at it from different research and different styles and come to the same conclusion, like very often that's like a pretty good signal that you got a good idea, right? Um, so I think the benefits of it really outweigh the downside, with the type of firm architecture, that we have, and it's certainly like helped our returns over time.
And I'm very interested in this kind of idea of if I wanted to raise a hedge fund and I went out today and I pitched a sovereign wealth fund or I pitched a pension, one of the questions they'd probably ask me is, what's your edge? And so how have you seen the nature of edge within the hedge fund industry change over the last 2 decades as a whole? What has it become?
Well, first of all, I think there's different um, quality, I would say, of capital that you can raise. So when you say like, want to go pitch a sovereign wealth fund, like to give you sense, like we had a sovereign wealth fund invest fairly recently, and the first time I met with them was 17 years ago.
Okay.
So that was the due diligence period. Now, you know, somebody else might be a lot smarter than me. Maybe it won't take them 17 years, but like it's like the high quality large pools of capital, like they're pretty rigorous on what they want to see and how long they want to see it for before they start writing, meaningful checks most of the time. So that's, one of the things that makes, starting hedge funds very difficult is like the quality of the capital that you typically get starting off. And certainly, a year, 2 years, 3 years into it, like it's very volatile. And so if you go through a difficult period, kind of comes back to that culture and edge. Can you maintain it? Not so it's much less about like, can you raise the capital? Like it's not that hard to raise some capital, but maintaining it and growing it through the ups and downs, like that's what's hard, right? In terms of like what edge to demonstrate, like there's different approaches, and it really depends on the person's skill set. So somebody could be a great, manager, right? And they're a great recruiter, great manager, great risk manager, capital allocator, um, and they have an ability to attract talent to them in a space that they really know well. So like that's one model, right? Another model is somebody is like a great trader PM in a particular area, and people are going to invest with them for their acumen in that particular thing. And they surround themselves with a strong team and strong infrastructure for that particular thing, and get the right amount of capital for the capacity that they can generate good returns on, and try to kind of like maintain and kind of slowly grow, from that. Right. I think people run into problems when they veer kind of from that core edge and the structure of the firm kind of doesn't match with their skill set as much. So if somebody's like a really good risk taker in a particular thing, that doesn't necessarily make them a great talent manager, recruiter, business builder. They might be, but most of the time they're not, right? And so you have to like match that up, right? I think that's really important, especially as like the firm evolves. And if that person doesn't have it, then bringing in people that really have like a different skill set. And that's, one of the areas that I was fortunate in. And we've always like invested a lot in bringing in top management. They're continuing to really do that, um, get things going, and then bring in folks to take it to the next level.
And I think a lot of people have this question in their minds of people know what analysts do, people know what PMs do, but people don't really know what like the heads of these large multi-manager hedge funds do. So my question to you is before I ask the final question, I ask every guest is as the CEO and CIO of a $30 billion hedge fund, what does a day in the life of Dmitry Balyasny look like?
Well, today was a very busy earnings day, so we're dealing with all sorts of earnings volatility and trading pretty actively, and talking to the teams about different ideas. The last few weeks, there's been crazy volatility in the commodities market, so spent a lot of time talking to the management team, the risk team, the PMs about what's going on in their space, how can we manage through it well, and helping hopefully add or at least not subtract value through that process. Figure out where you need to protect capital and where you need to lean in on stuff. Um, so a lot of it is market oriented, risk oriented, capital allocation oriented. So that's kind of like every day. Then the other big part is strategy development. So we split our business up into different strategy verticals. And for each one, we spent a lot of time thinking about like, where are we today? Where do we want to be tomorrow? Where do we want to be 3, 4, 5 years from now? How do we get there? Right? How do you compete? How do you win? Where can you build an edge? What kind of infrastructure do you need to build to get to the next level? Who can scale? How do we resource them for that? Where do we need to hire? So there's like a lot of strategy development, and that takes like, some business acumen, but also like market acumen to try to decipher between things that might be fleeting and things that might be enduring, strategies that you want to, invest in. So sort of like trades versus businesses, right? So we spent a lot of time on that in investment committee and just lots of conversations with the management team and senior PMs. And then the infrastructure piece is, increasingly important. So, I was in, technology meeting earlier in a trading technology meeting, like here's our trading systems, here's how we want to improve them. There's the targets. We want to enable, this strategy and that strategy. Here's what we're doing about it. So there's some time spent on that. And then another large piece is really recruiting. So, portfolio managers, business managers, senior department folks in different areas. I would say I do an average of probably a couple interviews every day.
Oh, wow.
And, some parts of the year it could be much more than that. And then even if I'm not the one doing the interview, like, triangulating with the hiring manager for that role and our business development team, figuring out like, does this sound like the right person? What are we looking for? How do we get this done? That's a super important part of the business if you want to grow.
Well, I want to finish off by asking my final question I ask every guest. I'm 16 right now. If you were to give one piece of advice to a 16-year-old today, it can be life advice, career advice. I'm pretty sure Jeff Yass gave me romantic advice. What would it be?
Oh yeah, I heard that one. That's pretty good actually. That's good advice.
Yeah. What would yours be? Any kind.
Um, I think one that I think about a lot is like carpe diem.
Seize the day.
Yeah, like you have to constantly have a balance between things that you kind of want to be doing and things that you have to be doing, right? And that never goes away, right? And I'm not saying like don't do anything that you don't absolutely want to do at that moment. There's, lots of things that you kind of have to do to get to where you want to get to. Um, but making sure you're spending enough time doing the things that you really want to do, you know, um, and creating, space for that. And then, thinking ahead, like, what do you really want to do? And, um, setting yourself up and doing the things you have to do to kind of get there so that you don't spend too many hours or years doing things that you look back on later as kind of a waste.
Yeah. Live with no regrets.
Yeah.
Well, it's been a pleasure, Dimitri. I'm glad we can make this happen. Thanks for coming on.
Yeah, my pleasure. Nice chatting with you.